Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to cash flow based on account activity. Get ready because it's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the blue area on the right-hand side. Now this is going to be a pretty quick intro into some cash flow concepts for our cash flow statement, the third financial statement. We have a balance sheet, income statement. Those are the main two statements because those are all of the financial accounts. Then we have the cash flow statement. Why do we need a cash flow statement? Because the balance sheet shows us, where we are at a point in time. Income statement shows us performance. However, that performance is not based on cash flow, but based on accrual concepts, when we did the work, revenue recognition, and expense principle. So that's really useful for performance measurements. However, we also want to have cash flow measurements. Therefore, we need a cash flow statement as well. Now, there's three components to the statement of cash flows, but I want you to kind of focus in on the income statement for now, considering the income statement because it's a timing statement. So we'll talk about more items on the cash flow statement later, but focus in on the income statement being the timing statement. So if you think about the income statement, we got revenue minus expenses is net income. There's two ways we can kind of convert that net income to basically a cash basis. We can take the net income itself and then back into the accrual components to back into cash flow on a cash basis. That would be an indirect method. Or we can basically, you can imagine reformatting everything on the income statement, revenue and expenses, to a cash basis rather than an accrual basis, in that way we would just basically rework everything. Now, the direct method, that would be the direct method to change all the accounts from an accrual to cash, would be more direct. It makes more sense to a lot of people. But the indirect method is often required, even if the direct method is used, because you have that nice reconciliation, which is nice. You got the net income is now being reconciled to the cash flows from operating activities on a cash basis, and that tying out, that reconciliation is nice. It's also a really good tool for us to learn the understanding between an accrual and cash basis and just better understand, the accounting and how the financial statements are put together. So what we'll do is I want you to kind of focus in on the income statement here because it's our timing statement that we're going to basically think about how can we convert that kind of to a cash basis. But and to do that, we're going to kind of back into some of the accrual counts that are on the balance sheet. And so we're going to think about these balance sheet accounts that wouldn't even be there if it weren't for the fact that that we have an accrual basis. And therefore, we can look at what the activity is in those accounts to back in to reverse the activity out to a cash basis. So you're imagining here, if you had an income statement, you'd end up with net income, right? Net income. And what we're going to do is kind of reverse out the types of things that would be accrual accounts to get to net income on a cash basis. That's the kind of concepts you want to think about, and we'll get to the cash flow statement in a little bit more detail later. Now, we're actually going to do that even though we're looking at the income statement by reversing some of these items on the balance sheet. Let me kind of see if I can break this down. I would think about this with two major accounts, receivables and payables, and then apply the concept to everything else. So for example, receivables would not be on the books if it weren't for the fact that there was accrual accounting. If we were on a cash basis, there would be no receivables. We would simply record revenue when we get cash. We wouldn't record people owing us money. So what are the accounts related to accounts receivable? It is an accrual account. It goes up. I'm not going to use debits and credits here. I'm going to try to just use increase and decrease. Accounts receivable goes up when we make a sale on account, and the other side goes to revenue. Sales or revenue increases. And then it goes down. Accounts receivable goes down when they get cash. Cash goes in, so cash increases because we got paid. And then we have AR goes down. So that's going to be the general kind of transactions that will happen. Now, this wouldn't happen under a cash basis. We would record sales and cash at the point in time we get cash under a cash basis. So you can see that this is causing the accounts receivable to go up, and it's causing sales here to go up, even though we didn't get any cash. So this increase due to us not getting cash needs to be reversed out for an accrual basis. And then when we got the cash, we might have gotten it in another period. So if we got the cash in a different period and it was just simply decrease in the accounts receivable, we should record the increase in revenue at the point in time that we got cash under a cash basis. So any kind of cash that isn't in cash that isn't in here because we recorded it in a prior period, we would have to increase here. So if you look at these two transactions, if we think about accounts receivable overall, the general rule for accounts receivable, I know I'm doing this a little bit quickly for this problem. We'll talk a little bit more about it later, but notice for the general rule, if it's an asset, such as accounts receivable is, if it increases, if the accounts receivable increases, then this transaction happened more than this transaction, and therefore we're going to decrease the cash flow. That means that we would decrease the cash flow. The 100,000 on an accrual basis would go down, right? And then if this happened more than this during the year, then overall this happened more. That means we had a decrease in accounts receivable or a decrease in an asset that will increase the cash flow. That means in the cash flow will go up. So that's going to be kind of the general rule. So you can derive that out. I would derive that general rule out with cash, and then you can apply that to all other accounts. The reverse will be true for a liability. If you did the same thing for accounts payable and thought this through, then you'd have the reverse thing happening. So the general rule then, and you can just memorize this in terms of the general rule so you don't have to think through this every time. Once you think through it a few times, then you want to apply the general rule, right? And I would think through the major accounts, which would be accounts receivable and accounts payable, to think through these concepts. So then the general rule is just going to be if it's an asset and it increases, then it's going to decrease the cash flow. So if it's a decrease to an asset, it's going to increase the cash flow, and the opposite will be true for the liability. So if we apply simply that general rule out that we can then derive, and you do want to think about deriving it down here as well, because it gives you a better understanding of the financial statements, then we can go through here. We can say, okay, if there's an increase in accounts receivable means there's going to be a decrease, and I'm just going to say equals decrease in the cash. And that's because over the year over year, last year compared to this year, if there was an increase, then that means this happened more than this, which means the income is overstated. So we're going to decrease it. And then if there's an increase in accounts payable, then we're going to do, so now there's an increase in accounts payable, so we're going to increase it because it's the opposite of the general rule for the assets. If we did a similar kind of analysis down here for accounts payable, you'd have a similar kind, you'd be able to break this out in a similar way as we did with the receivable. Then we've got depreciation expense. Now this is an expense. Whenever you think of depreciation expenses, you can also think of it as the change in the accumulated depreciation, which is a contra asset account. It's a little bit confusing, but it's a balance sheet account, and it's a accrual type of account. It wouldn't be there on a cash basis. So the depreciation expense doesn't have anything to do with cash. In other words, this $100,000 in net income is including a decrease due to depreciation expense, but no cash went out due to depreciation expense. Therefore, on a cash basis, we shouldn't have a thing called depreciation expense, and we got to increase it and put it back into place. So we're going to increase that item. Increase in investments. So now we're talking about investments, which is an asset account. If the asset account increases, then we're going to follow this general rule and decrease. And then we haven't talked about the categories that this will fall into, operating, financing, investing. We'll talk more about that later, but we're just thinking about the increases and decreases. So then we have a decrease in accounts payable. So accounts payable is going to be a liability account. So if there is a decrease in accounts payable, it's going to decrease because it's the opposite. We're doing the opposite of this general rule. And again, if you were to work it out down here using a similar process as we did with accounts payable, you could derive, a similar reasoning process for it. Then there's a decrease in prepaid expenses. So prepaid expenses, what is that? Is that an asset, liability, equity? Is it an expense? It's not an expense because it's expenses. It's prepaid, meaning we paid for something before we consumed it. The major example is insurance. So if we prepaid the insurance, it would be a prepaid expense. It's an assets type of account because it's something that we have benefit for in the future. And we're going to say that it decreased, so that means that we're going to increase it here following the same rule that we derived. You can kind of mull it over if you want to for a prepaid expense, but once you find it for assets, that general rule, and you understand it for accounts receivable, then you can apply it out. We're going to say if it was a decrease there, it's going to increase. Okay, we have an increase in inventory. So same thing, it's going to be an assets type of account. So the other side of inventory would be cost of goods sold, right? But same kind of concept. There's an increase in an asset account. Therefore, we're going to apply our rule out and decrease. And then we have the dividend payment. So a dividend payment. Now this one is a little, it's kind of more straightforward. It's an actual payment. So we know it's a payment that went out. It's in the equity section represented a payment went out. So it's going to be a decrease for the cash flow. And then we have an increase in accrued expenses. So accrued expenses, what is that? Is that an asset liability equity type of account? It says expenses. It's not an expense in that it's not being expensed in this time period. It's accrued. It's accumulating. Therefore, it's going to be a liability account. It's something that has accrued upward for which we have not yet paid. Liability is going to be the opposite of this rule. So if there's an increase, we're going to increase it. So that's going to be a kind of a quick intro to this. So again, you want to get an idea of this general rule, and then get an idea of accounts receivable and payable, and mull those over here. And then the best way to understand these is just to keep on working cash flow statements. And so we'll take a look at putting together cash flow statements in a future presentation.